Informative and unpredictable, testing the limits like only we can. From Span Enterprises in Rock Hill, South Carolina, it's The Bandit Room. And welcome to The Bandit Room. I'm Charles, this is Amber, and our special guest today is Mr. Adam Ackerman. Adam is a financial advisor and financial planner with B&A Wealth. So thank you for joining us today.
Oh, my pleasure.
Tell us a little bit about what it is that you do.
So what I do is I create financial plans for individuals, and when it comes to the individuals' financial planning, we take the holistic approach, not only investment and retirement planning, insurance, estate, tax planning, wrap that all into one financial plan because everything goes into the financial plan. Side note, we also, for our business clients, how we met you guys is, we set up different simples, 401ks, defined benefit plans, all that kind of good stuff.
Cool. All right, so drop some knowledge on us. Help the people understand better what they can do to better their investment future. So what are some basic options that people have? If somebody's looking to get into it, what are the options that they can use? Like IRAs, 401ks, these are all kind of words that people have heard before.
First thing, I make sure if someone comes to me off the street and they talk to me about investing, I got to make sure they have an emergency fund. Because you don't want to start investing for your short, intermediate, long-term goals and immediately have to pull out of that if car breaks down or some expense comes up that you don't know about. So that's something that we make sure all of our clients, especially early investors, they got to have an emergency fund. They need to have something on the side, checking savings account, that if something goes wrong, I call it the old shit fund. So that if oh shit, something went wrong. Hopefully that's okay on the podcast.
Okay, that's fine. It's permissible. We'll allow it. We'll allow it. All right.
But when it comes to the actual platforms of trading, there's retirement accounts, IRAs, individual retirement accounts. Stuff with your employer, simple 401ks, defined benefit, cash balance. Tons of different plans. The most common ones are going to be 401k plans that you safe harbor with the employee. Gives you a match and a vesting schedule if they have profit sharing.
How much would you say to have in an emergency fund?
Depends. Depends on if you're single, if you're married, what your income is, if you have dual income. I'd say in between 6 to 9 months of expenses. So if you got laid off, no expenses, 6 to 9 months of something there to where you wouldn't have to start pulling. Hopefully you could find another job within that time.
Right. All right. Now, a lot of people are lucky enough to have options through their job or something like that. What if they don't have that? Somebody isn't lucky enough to have some sort of work-based program. What do you suggest for those people?
So when it comes to retirement planning, if you don't have an option like a 401k or simple IRA at your job, you can just do a regular IRA. You can do a traditional or Roth.
And you would meet with somebody like you for that?
Yes.
Some sort of financial planner, advisor?
And there's tons of different people like us. You can go to, we're kind of on, I don't want to say the pricier side, but we look at the holistic approach. So, when we do just set up IRAs, we have clients who want that, and when we meet with them, we talk about the scope of work of what we're doing for them. But you can go online to Vanguard, you can go online anywhere, and you can get a Roth IRA or an IRA. And for someone who's just going to invest and hopefully not look at it every day and not, hopefully going to keep doing it every year, that person needs help. And that help is someone like us. We can talk to them about their risk tolerance, their goals, and from there build a portfolio that matches all of that.
Now you hear a lot in all the commercials out there for different services like what you do. They talk about the a holistic approach or like getting to know you and your particular goals and your particular wants and dreams. Now from an outside
what's
perspective,
your favorite one we talk about?
The TD Ameritrade one where it's like, I want to run with the Bulls. And anyway. So with that, from an outsider's perspective, it seems kind of silly because it's like, isn't everyone's goal just like make as much money as you can? Like whether you got to do it in 10 years or you have to do it in 30 years or it just like two questions, like how much time do you have and how much, you just want to make a ton of money, right?
Yeah, so that's That's a goal. I want to make as much money as you can.
Yeah.
But there's so many different aspects in there. You know, when you think of the market,
Yeah.
you think on TV, you hear S&P 500, you hear Dow Jones.
Mhm.
Those are the only things you hear. You
Right.
don't hear about what goes into that.
Mhm.
You don't hear about international that much. You don't hear about, you know, small, mid cap, large cap stuff. So it's really about creating a diversified portfolio to your risk tolerance.
Right.
Because if you want to make as much money as possible, that's going to put you at the highest risk tolerance as possible, which also means you can lose as much money, the most money as possible.
Okay.
So it's all about finding that balance to where you can sleep at night knowing that, you know, hey, I'm risking what I can do,
Right.
what you're comfortable with.
Okay, so it's all about risk tolerance, kind of picturing like how much you're comfortable with. Like if you're really going to go all in on something very risky, then you got to be okay with the downside.
Oh,
you know,
exactly.
If things don't pan out.
Exactly.
Yeah.
I mean, you got to look at it long term,
Yeah.
especially for if you're, you know, 20s, 30s, 40s, and you're unfortunately going to be working for another 25, 30, 40 years. You know, the market since it, you know, 1930s have averaged somewhere in between, you know, 7, 8%.
Right.
So look at it like that. It's never going to be, you know, a steady 7%. It's going to be up, you know, like last year up 20-something%.
Right.
Or down 10%. It's going to go like this.
Yeah.
So it's just staying invested, you know, and I mean,
Yeah.
you always hear buy low, sell high.
Right.
Everyone does the exact opposite. You laugh, but everyone does.
You buy when it's high because it's
you
like,
buy
oh,
when it's high
this
'cause
is
you
hot
hear it,
right now.
because
I
It's
gotta
hot,
get
it's
in
hot,
on
it's hot. Let's
that.
buy, let's buy, let's buy,
Yeah.
and it goes down, and then you're like, oh, I don't want this anymore. Let's sell it.
Yeah.
And it's just,
Yeah.
it's stupid.
It's obvious advice, but it's the hardest of
And that's a
all.
lot of stuff with my job as well, is the psychology. You don't really think of the financial planner having that, you know, I wish I honestly took more psychology classes to talk people, I don't want to say off the ledge, but,
Yeah.
you know, when the market's been great,
Right.
but at some point there's going to be a correction.
Yeah.
And I make sure my clients know that, you know, that's the one thing I can guarantee, that at some point the market will go down.
Right. Right.
And that's the only guarantee I can make.
Well, that's an interesting topic because right now things are good. You know, we're
Things are
doing
great.
this in early 2018, so you know the market's up, up, and up. So I mean, obviously things are going to move. I mean, that's just the way of it. You know, it's not like this is a temporary thing. Hopefully this is it'll go down, but it'll go back up even higher. But so what are your thoughts on the immediate future of that?
So when it comes to the, you know, what we think of the economy and the market right now, we think 2018 is going to be good. We don't think it's going to be as good as 2017, just because we think 2017's gains on the domestic side were baked into a little bit of some of the Trump tax reform that you know now is coming out with, you know, lowering the business tax, basically, you know, 14%. And you know what that does to companies is their PE ratios, their price to earnings ratios. You know, let's just say it was at, you know, 17, 18%, and you know you want to look at, I don't know, 15 or 15 on that earning ratio. Having it go down 14% right there, you know, that gets down under what you're looking at. So therefore, it goes from overvalued to undervalued just from a stroke of a pen in Washington.
Okay.
So there's different things that we're in a weird time when it comes to Washington. Everyone has their political views. Everyone, you talk to anyone, and they'll say, you know, they may be pro or against Trump. It doesn't matter. This just shows you that in a strike of a pen, how fast things can change.
Right.
And you just need to make sure that your CPAs, your CFPs, your financial planners, you need to make sure that they're keeping up with everything, because that stuff can wreck a financial plan.
Yeah. So talk a little bit about PE ratios. You mentioned that. That's obviously a big determinant.
Well, so that's kind of stuff how they measure if stocks are undervalued, overvalued.
Okay.
I don't really want to touch too much when it comes to PE ratios, whether it's, you know, stocks or
so essentially
growth or value. I mean,
Right.
it's you talk to a different advisor, they'll give you a different thing. So I don't really want to go too much into that. But what I can say is that, you know, when it comes to our portfolios, whether it's growth or value of the stocks or the ETFs, the mutual funds that we use, you know, we just make sure that it's diversified to their risk tolerance. And that's the most important thing of everything. I know I've said that probably 10 times, 5 times in this, but that's really the most important thing.
Right. So your advice would be not to focus on the little things. Let people like you handle that.
Exactly.
And not the little
exactly.
PE
Unless you
ratios and
wanted
things like that.
to You know, a lot of people I talk to, they want to be the do-it-yourselfer.
Right.
Do-it-yourselfer. And, you know, I tell them that that's fine. If you think you can do it without paying us to do it,
Yeah.
more power to you. Right now, with, you know, S&P 500 up over 20% last year, you'd be an idiot not to be able to make money right now.
Take
if
a
you're
guess
doing it
on
yourself.
it.
Yeah,
Yeah.
exactly. Everything's going up right now.
Yeah.
It's really when the downturn comes and when you really see, you know, the need for an advisor. And at some point, it's going to happen. We're in, you know, basically a 9-year bull right now. You know, since the financial crisis and, you know, mortgage collapse, everything's been doing great. Especially United States. And if you look at, you know, the last year, 2017, that's when the international markets really, you know, caught up. Because they were lagging since the financial crisis. But, you know, last year, international was up, you know, 30 or so percent.
Oh, yeah?
Yeah.
So you're saying a culmination of things happened in 2017.
Oh, yeah.
Not only the political climate here in the United States, but also internationally.
Oh, exactly. I mean, that's one of the major factors of why our market went up so much.
Interesting.
Because, I mean, I heard a stat the other day, I don't remember what I was listening to, but I think only 5% of nations now are not growing.
Wow.
Which is an all-time low.
Wow.
So everything is growing right now in the entire world. So, you know, it's a weird time to cut taxes when everyone's making more money.
That's true. Well, hey, another thing that's in the news right now is cryptocurrencies. People are talking about that all the time. There's like tons of different cryptocurrencies. Obviously, the big popular one everybody knows about is Bitcoin.
Yeah. If I had $1 for everyone who asked me about Bitcoin, I would be able to buy about 1/8 of a Bitcoin.
Exactly. So should people care about it, or should people be taking mortgages out to get Bitcoin?
No, please don't take a mortgage out to get Bitcoin.
You have to these days.
So I see cryptocurrency, blockchain technology, I see a place for it. Right now, it's just, is it a currency or is it collectible? Right now, it's a collectible.
Yeah.
It's not being used as a currency. It's not, you know, you're not buying stuff with Bitcoin. I know, you know, in some major cities, you know, San Francisco, New York, they have Bitcoin ATMs or whatever. But even to, you know, buy and sell Bitcoin through Coinbase, apparently, I mean, it's issue with transaction fees and different stuff. So it's really figuring out, is it a currency like it's supposed to be, or is it collectible?
Right.
I mean, I can tell you that I'm more intrigued with the blockchain technology behind it, cutting out the middleman and just having, not only in the currency world, but in the whole aspect of everything. I mean, for example, think about records for medical stuff. Where you had to go to the hospital to get everything. Imagine if it was just a blockchain to where you could, you know, all these different things to get the keys and it's there. It cuts out the middleman, it cuts out time, cuts out money, cuts out so many things. I mean, to answer your question about Bitcoin, I'm personally invested a little bit myself. I will say that I got in, I mean, I won't say I got in late, but I got in, you know, mid last year, and I sold out what I put in. So I'm riding out totally gains. So I tell people about Bitcoin, you know, think of it as if you're at the craps table in Vegas.
Exactly.
You know, put in what you're willing to lose. Because we could go to sleep tonight, and tomorrow it's worth nothing.
Yeah.
So if anything, if you really want to get into it that bad, no more than, you know, 3 to 5% of your total portfolio. If you're, but you know, I may be in the bandit room a year from today,
and looking back on it,
and maybe worth $50,000 a coin, or maybe $50 a coin. Hell, I bet Bitcoin from the time we started this to the time we end it is
it's
fluctuated by at least $100. I can almost guarantee that.
Yeah.
So it's just it's a weird place, but you know, everyone's talking about it. Even you know, my grandma's talking about it.
Yeah.
You know, and she
So
doesn't even know. She doesn't even have an iPhone. She still uses a, you know, flip phone where you got to text by hitting the number 3 times.
Yeah.
So it's just she hears things on the news, and it's just a lot of things you hear that, you know. There's 3 things that I tell people to start. I'll kind of go back to what I said about the emergency fund.
Sure.
That's the number 1 goal. That's the one thing we see with investors who mess up. They don't have an emergency fund. Number 2, they don't buy things on discount. So, you know, they don't. So if you go by the gas station, riding down the gas station, and you see one gas station is $1.50 less, but you have, you know, half a tank, fill up there. Or it's like going to Costco and buying toothpaste there. It's cheaper. You're going to use it. do it then, they don't buy things on discount. They sell on discount because they lost the money, so they sell. And 3, don't listen to the media. Whatever you hear on TV, it's paid for by somebody.
Don't buy the news.
Yeah, don't buy the news because it's
fake news.
Well, I'm not sure it's fake news, but it may be fake news. It may be real news. It's tough to tell nowadays.
No,
you really don't know.
Yeah,
I mean,
your point is don't buy what's trending. Like,
Yeah,
buy something for the long term.
Yeah, exactly, and it's impossible to say what sector of the market is going to be the best. You know, you can have analysts analyze income statements and balance sheets of companies and different sectors of things, but you know, unless you're, I mean, me personally, I'm not a stock picker. You know, we have our analysts that we pay that pick stocks. We have clients who use stocks. Mostly, you know, we use ETFs and mutual funds in our portfolios, just because we can talk about active and passive investing strategies and how, you know, they hit heads together, which one's better. And, you know, we believe in both of them. Me personally, I think, you know, right now, with the bull market we're in, can't be passive with those low expense ratios. They're following the index. Index is up. You know, S&P, Dow, you know, international. Everything's up so much. Follow those indexes. Where I really see the need for active management is in fixed income and bonds, because you know, with our interest rate environment being as low as it is, you know, that's where we really see the active management of having human capital behind it.
Okay. All right. Now, you mentioned ETFs and mutual funds. So that explain a little bit about to somebody who's completely new to that as to what that is. So people can either invest directly in stocks
or ETFs. Yeah. So So there's basic stocks, bonds, stocks of companies, bonds. You know, corporate, muni, all different types of bonds.
You're investing directly in that company. Whereas with an ETF or mutual fund, you're investing
in a basket.
Yeah.
So ETF or mutual fund is a basket of stocks that, on the ETF side, tracks an index. So hundreds, thousands of different indexes. It could be the S&P 500, the Dow, the international. It could be sector. It can be, you know, biotech, tech. You know, consumer staples. It can be anything that it actually tracks, but it's going to track it. And you know, they have lower expense ratios when it comes to the internal fees in the funds. And that's a lot of things that investors don't know about, and they wouldn't know about unless their advisor talks to them about the actual internal fees in these mutual funds. I mean, our company at B&A Wealth, we use the lowest expense ratios possible. Just because it's cheaper for our clients.
Right.
But there's a lot of things that's wrong with our industry. There's a lot of people in our industry are just in it for greed and money, and they aren't fiduciaries for their clients. Us being fiduciaries, which means a fiduciary means that we do what's right for our client before us, which you would think in our industry would be standard, but unfortunately it's not. In the Department of Labor ruling that they're some point is going to pass the fiduciary rule, where they're moving a lot of stuff to fee-based accounts instead of commission-based accounts, is great, and we believe that's something that's great for our industry as a whole. We've been doing that forever, but you know,
so how does that work on a practical level? So how is that new rule that you're going to say?
Well, let me take a step back to your questions, because we kind of skipped over what, you know, mutual funds and the ETFs. We kind of you know, tangent a little bit.
So it's mini baskets.
So it's just a basket of stocks and bonds. And, you know, mutual funds can be, you know, balanced, international, emerging markets, domestic. They can be, and there's hundreds, thousands, you know, different types. And they can, you know, stocks, bonds, government securities, cash, everything built into one. So when you buy a mutual fund, you can see in the prospectus, you know, what exactly it's invested in, what the goals are, all that good stuff.
Gotcha.
So, you know, when you're investing, and that's why you need an advisor to really talk to you about, because, you know, someone off the street who isn't, like, I mean, for your guys' stuff, I don't do software. You know, I don't know how to design software. I would have to come to someone like that. So it's just it's a whole different thing. So, but I can now touch base on. Well, I don't even remember what we were talking about.
The fiduciary rule.
Oh, the fiduciary rule. Yes.
So you're saying it's a law. You think it's probably eventually going to pass.
So it's going to pass. Obama tried to get it through previously, and Trump's tweaking it a little bit, but the cat's out of the bag now.
Right.
So people
and it's more of a consumer protection type thing.
Exactly. Exactly. So right now it's only for retirement accounts.
Mhm.
So, you know, IRAs,
Mhm.
401ks. 401 and business is big.
Mm-hmm.
A lot of stuff was going
Right.
behind closed doors to
Mhm.
board directors and different things where it's
Gotcha.
a little fishy of things. But it's really just making sure you're doing what's right for the client. And you have their interests first, which you would think would be common, but it's just,
Hmm.
it's not, which
All
is sad.
Awesome. Wow. Crazy. All right. Interesting. This has been eye-opening, Adam. I appreciate you coming by. Thanks for coming by.
Yeah,
man.
no,
I really
thanks. No,
appreciate
it was a
it.
pleasure,
Any
you
parting
know.
words for any listeners?
No, I mean, I
last
think-
minute advice. You had your 3 points there.
I think just the emergency fund is huge for, you know, not only young investors, but all investors.
Mhm.
Because you're investing for long-term goals, especially for retirement if you're in your 20s, 30s, or 40s.
Yeah.
And like I said, unfortunately, you're going to be working for another 20, 30, 40 years unless you win the Powerball.
Cool.
Which in that case, you need a CPA and an advisor even more. But
Definitely talk to somebody. Definitely get an advisor.
yeah, but it's just, I mean, I think we cover everything, and it's,
Cool.
yeah,
Awesome.
it was a
All
pleasure.
right. Anything to plug? BNA Wealth?
Oh,
So it's a
I
new
mean,
thing?
how much more time you got?
No,
No,
you go
I
how long
mean-
you want.
I mean, BNA Wealth, we have the whole holistic approach. So we have, you know, BNA CPA and advisor as well. You had Jason Ackerman on here previously during the Bandit
Yeah,
Room.
yeah.
And
I
that's
like
my,
all the Ackermans.
that's my older, you know, not as good looking brother. He's on the CPA side. I'm on the
Yeah.
financial plan. We're both CFPs, but
Mhm.
where he's on the tax side, I'm on the investment side. So we
Mhm.
work together and we look at just make sure everything on tax,
Mhm.
investments, insurance, estate,
You do it all.
everything
Yeah.
is under because everything goes together.
Yeah.
You
Go
know,
with the
especially on
people you
insurance
trust.
for the old people with I won't say old people, but old people. You know, let's say 65 plus with Medicare and knowing what Social Security and knowing the strategies to take for all that. That's a huge part of retirement planning too that we didn't even
Yeah.
touch on. That
Yeah.
a lot of older folks who are going into retirement think they just need an advisor to get to retirement. When you
Right.
get to retirement is when you really need the financial advisor because that's when you need to make sure you don't outlive your money.
Yeah.
And that's everyone's goal.
Kinda like
I can ask you what your goals and objectives are,
Right.
but if your goal is to outlive your money,
Yeah.
then there's something wrong with you.
Right.
So,
So it's kind of like an exit strategy.
yeah, that's an,
It's like
that's an extra strategy, like a 9mm. Is an exit strategy, so.
All right. Well, thanks
Well,
for
this
coming.
turns out. All right.
Thanks again for coming by. This has been good.
Is that ever happened in the Bandit Room before?
No, that's the end. That's the end. We're going to end all the episodes like that. That's the end, like a 9mm. Anyway. Oh, yeah, thanks
Good.
for coming by. Stick
Yeah.
around next week, see what we talk about in the Bandit Room. Thanks for joining us.
Thanks, everybody.
Thanks.